Hey everyone, wrongful trading is a significant concept under Singapore's Insolvency, Restructuring and Dissolution Act. It holds company directors accountable when they continue to trade despite knowing that the company is headed towards insolvency with no reasonable prospect of recovery. Under Section 239, subsection 1 of the Insolvency Act, wrongful trading occurs when the company directors, at some point before the company enters liquidation, knew or ought to have known that there was no reasonable prospect of avoiding insolvency, but continued to trade, thereby worsening the company's financial position and increasing creditors' losses. In simple terms, imagine a business that is struggling financially. The directors know that the company cannot pay its debts and is unlikely to recover. Yet, they continue operating, incurring more debt and making promises to creditors they cannot keep. Wrongful trading laws exist to stop directors from taking such reckless actions that harm creditors further. The concept originates from UK insolvency law, particularly the Insolvency Act, and has been incorporated into Singapore law to promote responsible corporate governance. The rationale behind wrongful trading is to ensure that directors cannot simply take risks with other people's money when the company is clearly headed towards insolvency. It aims to protect creditors by discouraging reckless behavior and holding directors personally liable if they breach this duty. To better understand wrongful trading, consider a few real-life scenarios. In the first scenario, a tech startup called Innovate X faces severe financial trouble. Sales are down and debts are mounting. The CEO, however, remains overly optimistic and continues borrowing money, signing new contracts, and ordering expensive equipment, hoping for a big investor to come through. When the investor backs out and the company collapses, the liquidators investigate and find that the CEO ought to have known that insolvency was inevitable, but still took on more liabilities. This is a clear example of wrongful trading. In another case, Green Earth Private Limited, a company selling eco-friendly products, has been losing money steadily over a year. The directors ignore red flags, including delayed payments to creditors and staff layoffs, and continues trading as if nothing is wrong. Eventually, the company goes insolvent, and the liquidators discover that the directors had enough information to realize the company was beyond saving, but failed to act. Their inaction and failure to cease trading amount to wrongful trading. A third scenario involves ShopSmart, a retail company struggling financially. The directors, hoping to revive the business, take out a significant loan to purchase new inventory. Unfortunately, sales don't improve and the company goes bankrupt shortly afterwards. The liquidators determined that the directors took on excessive debt when insolvency was foreseeable, worsening the creditors' losses. Therefore, the directors could be held liable for wrongful trading. These examples illustrate how wrongful trading works in practice and why it's a crucial part of corporate law. The law ensures that directors are not only focused on potential business recoveries, but also on the responsibilities they owe to creditors. It strikes a balance between encouraging entrepreneurship and protecting those who might be left unpaid if things go wrong. From a legal standpoint, wrongful trading holds directors accountable and prevents them from gambling with creditors' money when the company is already in financial distress. The importance of wrongful trading laws cannot be overstated. They encourage transparency and responsible decision-making among directors, particularly when the company faces financial difficulties. Directors are expected to act in the best interests of the company's stakeholders, and wrongful trading laws help enforce this obligation. By holding directors personally liable for reckless behavior, these laws protect creditors and help maintain trust in the corporate system. To conclude, wrongful trading under Singapore's Insolvency Act is about ensuring that directors act responsibly when their companies face insolvency. It protects creditors from unnecessary losses caused by directors who continue trading when there's no realistic hope of recovery. Understanding this concept is essential for directors and business owners, as well as anyone involved in corporate finance, to avoid potential legal consequences and to ensure ethical business practices. Thanks for joining me in this discussion. Don't forget to like, share, subscribe. I'll see you in the next video.